Picture this, you're grinding all year long, late nights, managing those demanding clients, pushing tirelessly to grow your revenue. You are doing everything right. But what if I told you that you're quietly hemorrhaging money? And why? Simply because you're missing out on entirely legal tax deductions.
Right, so tax season rolls around. You submit your return, pay up, and wipe the sweat from your brow. Done. But what if you later found out you legally could have saved thousands of dollars? Imagine hustling all year to build your business, only to realize at tax time that you literally just handed over thousands of bucks that you could have safely, legally, kept right in your own bank account. Ouch.
Now listen, we are not talking about exploiting shady gray areas here. Zero loopholes, no secret tricks. Just missed opportunities that you are already fully entitled to claim. In this explainer, we're diving deep into 5 highly overlooked tax deductions that countless small business owners either completely forget about or frankly never even knew existed. And hey, you're definitely going to want to stick around for number 5. It is a silent margin killer that almost everyone misses, and it's quietly siphoning money out of your business every single day.
Okay, before we jump into the list, let's just nail down a quick definition so we're all on the exact same page. A deduction doesn't just magically wipe out your taxes entirely. Instead, it reduces your taxable income. What that means is your tax liability is calculated on a much smaller number, so ultimately, you keep more of your hard-earned cash. It's a super simple concept, but it's crazy how many business owners spend way more time obsessing over top-line sales than actually understanding these bottom-line deductions.
Section 1. Workspaces and wheels. Let's get into it.
So, deduction number 1 is the home office. If you're managing clients from your dining room table or maybe running an online store from your spare bedroom, there's a really good chance you are entitled to claim a portion of your internet bill, your utilities, and other workspace costs. People routinely skip claiming these expenses because they're terrified of making a mistake. And yeah, the requirements do vary depending on where you live, but ignoring this area completely, you're literally leaving legitimate money on the table.
Moving on to deduction number 2, your business vehicle. Think about it. Do you ever use your personal car for business? This covers everything from driving to daily client meetings, running a quick business errand, making deliveries, all the way to far-off site visits. Depending on the local rules, a portion of these vehicle expenses very often qualifies for tax treatment. But here is where we hit the absolute biggest mistake with vehicles. If you're just relying on your memory at tax time, instead of actually tracking your mileage and expenses year-round, you lose the opportunity entirely. I mean, let's be real. You simply cannot reconstruct 12 months of driving history from memory in April. It's impossible. Without diligent year-round records, those potential tax savings just vanish right into thin air.
All right, Section 2, Education and Digital Tools.
Deduction number 3 is professional education. Look, to stay competitive out there, you're likely investing in courses, certifications, specialized workshops, maybe even flying out to industry conferences. These expenses are absolutely vital. They level up your business capabilities and streamline how you operate. Yet because they aren't, traditional physical office supplies sitting on a desk, they get forgotten during tax prep all the time. The golden rule here, always maintain proper digital receipts for any training that improves your business.
Now, deduction number 4 targets your digital infrastructure. Just think about what it actually takes to run a modern company today. You probably have monthly subscriptions for accounting software, CRM systems, design tools, cloud storage, project management platforms. The list goes on. It creates this massive, tangled web of recurring monthly costs.
So the crucial point here is that while we easily remember those big, flashy purchases, like buying a brand new laptop or fancy office furniture, we completely overlook these recurring monthly digital subscriptions. We tell ourselves, oh, it's just 20 bucks a month, no big deal. But listen, a few of those small subscriptions easily snowball into $1,000 over 12 months. They slowly, quietly drain your accounts, but they are incredibly potent when you bundle them together as a legitimate business deduction.
Section 3. The silent margin killer. Here we go.
We have finally arrived at the big one. Deduction number 5. This silent margin killer is bank fees and payment processing costs. Look, if you accept credit cards or use digital payment platforms, you are paying a premium for that privilege. This includes merchant processing fees, payment gateway charges, your standard banking fees, wire transfer fees, and platform transaction costs. These little fractions of a percent, they hit your account automatically every single day on almost every single transaction.
And, the psychology behind this financial drain is actually fascinating because these fees are deducted automatically in the background. Often way before the money even hits your main checking account, they fall into what we call an automatic trap. They are just so incredibly easy to ignore. Business owners are consistently shocked by how much these hidden little fractions total up to annually when they finally run a report. Seriously, it is a massive, highly legitimate deduction that you absolutely must be claiming.
Which brings us to Section 4, your year-round action plan.
So how do we stop this bleeding? Well, to fix this, you need a proactive system, not some panicked last-minute scramble in April. Here is your blueprint. First, track your expenses year-round and keep rigorous digital copies of your receipts. Second, firmly separate your personal and business finances. Never mix the two. Next, review everything quarterly to avoid nasty surprises. Maintain organized records throughout the year. Take the time to really understand the specific deduction categories relevant to your exact industry. And finally, absolutely always consult qualified tax professionals.
Section 5. Keep what you earn.
Ultimately, building lasting wealth isn't just about maximizing your incoming revenue. There is a massive, fundamental difference between grinding day and night to make money and strategically keeping what you earn. A successful tax strategy versus an incredibly expensive tax season, it almost always comes down to simple awareness. Small deductions like that random software subscription or that daily merchant fee we talked about might seem totally insignificant on their own, but combined over time through a deep awareness of legitimate business expenses, they become truly meaningful savings. The business owners who really understand their finances are the ones making stronger, more profitable decisions all year long.
If you found this explainer valuable, make sure to hit that subscribe button for NexClaim. We are completely dedicated to bringing you more of these high-level insights on taxes, insurance, banking, investing, wealth building, and basically everything you need to know about small business finance and consumer protection.
But hey, before you go, I want to hear from you. Which business expense do you think most entrepreneurs completely forget to track? Drop a comment below and let's get the discussion going, because mastering your finances is a year-round job, and it starts with taking a hard, honest look at where your money is actually going. See you in the next one.